Mortgage 101 podcast with Anthony and Manley.
Welcome back to the Mortgage 101 podcast with Anthony and Manley, the show that helps you cut through the noise, understand the process, move forward with confidence in any market. Let's get into it. You're listening to the Mortgage 101 podcast with Anthony and Manley. Today's episode, why are home prices still rising? We're diving into the surprising reason why prices are going up, even with rates over 7% and home sales slowing down. Plus, stick around for our new rapid fire buzzword segment where we break down mortgage terms you actually need to know. Let's get into it. Welcome everybody to the show. Glad you're back. If you're first time listener, first time joiner, happy to have you here. Hope you come back. Hope you find something enjoyable, interesting, and educational on our project we're working on here, the Mortgage 101 podcast. But hey, let's jump into it a little bit. I want to just dive right in. We got a hot button issue out there. What's going on? Home prices are still climbing while interest rates are still above 7%, don't seem to be coming down. And we have a little bit of slowdown in actually the sales of the homes that are out there that are on the market. So we got a weird combination of stuff that's happening. We're going to talk in depth about that. We're going to go through all that. Anthony's going to give us some insight. We're going to banter back and forth on that. We also have the ever favorite by fans, the rapid fire mortgage term section with our friend Kevin. He's going to whip some stuff at us, try to learn something here about, what some mortgage lingo is, what things, terms and technology and the terminology of the mortgage lingo. So there you go. So, Anthony, let's start here. Rates have just surpassed 7% again. We're going up. We've had today alone, we've had multiple alerts to lock. We've had multiple rate changes. What is going on? Following the U.S. downgrade in the credit, but there's other things that are happening. What impact is this happening on affordability and homebuyer confidence right now? We got a lot going on right there. Very complicated. Hit me with your best thought.
Yeah, I mean, welcome to the market roller coaster because, at one end, we're like, hey, once these tariffs end, we're going to see rates go down. And then bam, we get hit with a credit downgrade. Now, in layman's terms, that credit downgrade is basically like an overseer to say, are you balancing the budget? Are you managing your business right as far as an economy on a world scale? And, it's a small downgrade. We're still on the very top as far as how we manage things, but it is a precursor and it's kind of a nudge going, hey, y'all need to get your stuff together. The problem is you cannot keep raising the debt ceiling and think that there's no repercussions. And so now we're coming to that, hey, like enough's enough, balance the budget. And so this is kind of a precursor to say, like, y'all need to balance this or we're going to make it hurt on a geopolitical scale. So right now, we're looking at, rates right now are just surpassed 7%. So 7.1% is where the average is right now as far as May. Now, the good news is Fannie Mae is still thinking we're going to see rates in the low twos, around 6.25 by the end of 2025. Now, I know a bunch of our viewers are like, when are we going to get to the 4s and 5s? That's what we want. I want you guys to understand something. 4s and 5s is just a number, okay? It's all about the affordability. And so if we can get that affordability based off of the seller's back, then the 4s and 5s are going to come. They will come. Are they going to come in 6 months? No. Are they going to come in 2 years? Most likely, yes. Are we going to ever see 3s and 4s again? Not. Absolutely not. That was unicorn days, and that unicorn is gone. That is lucky charm away. But, I mean, because of the downgrade, it's putting a focus on how do we fix this for long term, not just a quick Band-Aid, throw money here, do stimulus here. It is a precursor. It runs parallel, but it is not the mortgage rate because that's basically what the bank is able to borrow to be able to give people money. And so the less the Fed rate, the cheaper it is for the banks, the cheaper it is for the end user. So will I see quantitative? Will we see quantitative easing or printing of money? Yes. But the Feds have to do it in a systematic way because if they start dragging down these rates quickly, that's going to make the demand go up, make the supply go even lower. And now we got an even bigger issue because home prices are now going to be exploding. And that's what we don't want.
We gotta curtail that effect of what possibly could go wrong here. And the quantitative easing that may possibly come in, it's absolutely got to be spot on. We can't mess with it. And they are going to hold those cards to their vest as long as possible because it can be disastrous. So let's keep our eye open for that. But time will tell. All this stuff that's been going on, anytime anything happens, the media, everybody's just expounding this whole problem in itself, talking about it as we are right now, and it's creating havoc in the market. We have the roller coaster that we have never had ever in our world. But hey, what are you going to do? So let's address the elephant in the room. If home sales are at 30-year low and inventory is up almost 20%, why are prices still going up? I mean, this is a loaded answer, loaded question. We know the answer to it, and we just talked about it a smidge in the last little segment there, but I'll let you take a whack at this for us, Anthony. Tell us your thoughts.
Yeah, I mean, so everyone is, waiting on bated breath for these home prices to come down, right? Because people are like, hey, if there's people not buying, inventory is skyrocketing. You hear, that inventory is up massively, almost 20%, but that's 20% post-COVID. I mean, when you look about it, we had a drought in 2020 and 2021 because of COVID. The builders can't catch up fast enough. They're not building and just taking permits and throwing it out there. They're only doing it based off of people who put money down. It is not like pre-2018 where they were just building thousands of houses and expecting people to come in. They've learned their lesson. They're not doing that. Sellers are rate locked. When we switch over to, the supply, why is a seller who has a rate in the 2s and 3s going to sell their home for 6s and 7s? If they were smart, which they are, most of them are, they would leverage that debt, not offload that debt. So they would rent it out. They would take out a second, buy another house or do whatever they want and have the renter pay for it. So that's also adding into the supply and demand issues. The demographic is strong. When we look at our Gen Z and millennials, they're buying, but the problem is they don't make enough money. The days of 1950s TV dinners and a picket white fence and the man coming home and, hey, honey, where's my dinner? That's gone. Like if you got one earner household, you're destitute. You make it top ramen. There's no Chipotle in your life. That's the problem. So if people,
hot dog soup,
what was that?
Hot dog soup,
dude, ham and cheese sandwiches, delight, that's because the cost of living is so much exponentially higher. And so, and here's another thing too, and this is what I think is most important as far as the Gen Z millennials. Gen Z millennials, you listening? Okay, here it is. All right, it's going to blow your mind. All right, I hate to tell it to you guys, but back in the days, people used to play baseball, kick the can. They used to go on a family trip to the mountains. There was no Starbucks. There was no Disneyland. There was no Audi A5s. So when you look at the quality of life that we're living with these extravagant dinners and these extravagant vacations and all of these nice clothes, we did not have that back then. Things were simpler. So you cannot compare apples to bananas. You can't look back at your forefathers and go, well, they didn't have issue. Well, they weren't driving $70,000 cars, buying $100 dinners and saying hi to Mickey 2 times a year. So that is the issue. If people lived within their means, then it would be a big difference. Another thing, construction costs are high. Okay. The labor, the materials, trying to find people to work, for Christ's sake, that is also adding in, and builders are putting that into the price. And so when we look at that, it's just, there's no way. We got sticky pricing. It's going to stick and it's not going to change. There's no reason for it to change. The sellers are not panic selling. They're not like, oh my God, I'm going to lose all my equity. They can lose 50% of their equity and still be swimming in equity. So if people are waiting on the sidelines for house prices to come down, little FYI, they're not. So if you're looking to buy within the next 5 years, these next 6 months are probably going to be the most economical because you can take some money from the seller.
Yep. And again, we've talked about this before. In the event that the buyer pool grows, it's going to make the pricing even more expensive on the homes. The equity position, they're going to come in. So if we lower rates, increase the buyer pool, it's going to be the same homes that are still for sale. It's going to be that same people that are making smart decisions and turning their homes that have a 2 or 3%, turning it into a rental property that has a 2 or 3% mortgage. So it's a circular situation. And as you said, there's not enough. We can't build fast enough. But your bigger point that I loved was the discretionary spending priority is completely different than it was 20 years ago, let alone 40 years ago. I mean, we didn't have all that stuff. We couldn't go and spend $30 through the drive-through at Starbucks to get 3 coffees. You didn't do that.
Oh, better yet, my favorite is a statistic came out and said the average American is spending $500 a month on technology. What does that mean? Phones, cell service, cable, internet, Fubu, Netflix, $500 a month. I mean, so when I love it when I get my Gen Zs and millennials, they come to me and go, Anthony, I want, a $1,500 mortgage. I can't afford a $2,000. And I go, well, I'm looking at your bank statement. And if you chop this away, you can actually afford $2,500. Now, would you rather invest in yourself and see, pay down principal, earned equity, tax incentive, future cash flow? Or would you rather have that prime subscription? Which one is it? And they're like, yeah, you're right. I'm like, listen, it's temporary. You'll live within your means. A big thing with me, the living within the means came into perspective with me when I was a meter reader for the power company, making like $15 an hour. And I was living on a street and I was renting. I had a $1,200 car that my kids named a dead cricket in the back window, Harvey. And it was just, things were simpler. Speed up like 5 years later, I ended up getting like a $300,000 power trading job where I went from making $15 an hour to like $15 a minute. It was crazy. And the funny thing is I bought a house on the same block. It was just bigger and bigger cost. And I was driving down the street and I was like, well, damn, I'm making all this extra money and I'm on the same street. And so we live within our means. You just got to know what you're doing and look at the paperwork because the math never lies.
Well, at the end of the day, we're talking about many factors that are affecting this market. And there's more than one lever here that's getting pulled to get us in this position that we're in. And until we make a conscious effort to change some of the dynamics of it, which some of it is completely out of our control, we're going to be sitting here for a little bit. So rates are going to eventually grind down. Prices are not going to come down with that. They're going to continue to climb. Equity positions are still going to be great. And we're all going to be in a great spot, with our home ownership as the American dream. Anyway, let's zoom into the inventory stat that, hey, 19.8% year over year. We just talked about this. Buyers feel hopeful that something's going to change. I don't think we're getting there.
Yeah, I mean, here's the thing. The inventory going up, we still have historically low and we're not meeting the demand. We're just not. So it's very it's know your audience, but also know your source. When you see on the TV captions, they don't want to give mundane, bullet points. They want to give stuff that's shock and awe. And when they say 20% inventory raise, but then you're like, yeah, that's based off of the last year, but we're already 150% under. Show the big picture here. And that's the thing. We're not going to see the floor shift because we could see another 30, 40, 50% increase and we're still not going to meet the demand because we're almost 60% under of what we should be doing. All thanks to BlackRock and those big hedge fund companies just taking up communities and making them, brand new for rent type of deal because they know the long game and they see it, that there's a housing shortage and it's the new stock market in a physical asset. But I want to emphasize, right now, if you're buying, you have more options. It's a catch-22, but if you look at it face value, option one, we have low rates, but then we have no options and you're settling and you're paying higher dollar. Or option two, you have higher rates, but now you're not settling. You get what you want, and you get the seller to pay concessions to save money out of pocket. It's pick your poison. It's the same, but the big difference is now you're not settling. Now you're not going for the house that's out of your school zone, or you're not going at a house that's not next to your work, or now you're not settling if you wanted a single story, but now you got to do a 2-story, and you're like, man, I got to truck up and down the stairs. So right now you don't have to settle. People have amnesia. Remember in 2020 and 2021 with COVID, people were paying $30,000, $40,000 over asking. There was 20 offers on one house, and people were doing it. They were smart because they knew the rates were in the 2s, and they knew that it was going to continue to go up, so that 40,000 would be absorbed. I'm telling you right now, if you're going to wait, you're not going to wait for economics. You're waiting for worse aesthetics.
You're absolutely right. The time is now. Act now. I've been talking to all my people. The sooner you get in, the better off you're going to be. This elevator is going up, and it's going up quickly. And if rates do grind down, it's only going to make it worse. So we're all on the same page there. So appreciate that. And that's the waiting game. Stop playing it. Figure out how to make it happen. Get yourself out there in the market and see if you can get yourself an opportunity to be a homeowner. So that's reality. All right. So now we're coming to our favorite section, our rapid fire buzzwords with our friend Kevin. Kevin's going to shoot some stuff at us here, and we're going to jump back and forth, and we're going to both talk about what's what and this chime in, but we're going to let Mr. Hawaii go first. He's got a big week ahead of him here, so we're going to let him take the lead. Tell us what's going on, Kevin. Here, jump in and get us.
All right. Rapid fire buzzwords. So try to limit this answer as short as possible in a few sentences.
You said as long as possible, Kevin? Is that what you said, as long?
None of these are spelling related. Number one, Anthony, APR.
Okay, the APR, the infamous APR, where people think that's their interest rate. That is not the interest rate. That is the annual percentage rate. It's your interest rate plus whatever fees are in the loan. It's a hard way to determine if it's economical or not, because a lot of things like mortgage insurance upfront and a lot of other fees don't really show what the short-term and long-term is. So the APR is good to know, but really the rate is the main driver of what you're doing.
So it's a divisional thing, correct, Anthony, where we're taking all the loan costs, all the mortgage interest for the life of the loan, redividing it by the number of payments, and it's going to give you a new APR rate as a percentage. And
that's
ultimately,
right.
It's typically going to be a little higher than what the actual interest rate is, your day-to-day interest rate is, and it helps people decide, is this accurate? Is there too big a gap? And do I understand why there's a big gap?
Correct.
Pretty simple, pretty straightforward.
Yep.
All right. Manley, you get the first on this next one.
All right.
Cash to close. What does it mean?
All right, folks, cash to close. To me, this is a very important explained thing that most lenders don't take the time to tell, especially first-time homebuyers, that, hey, just because you're putting 10% down, that's not all the money you're bringing to the table. So I do a very in-depth process of explaining what are the funds above and beyond the down payment that you're bringing to the table, which are the lender costs to produce the loan. What does it all entail to actually produce a loan besides the lender fee, appraisals, title work, credit reporting, all the other little miscellaneous things that have to get done. So that's one figure. And then you have prepaid items because you have to have a year's worth of homeowners insurance put in place. So there's that. And then you have to have the interest to get you to the end of the month. So that's your prepaid interest. And then you have your escrow holdbacks, your escrow accounts. You have 3 months worth of taxes and insurance set aside in an escrow account. And all that is your funds above and beyond. Your cash to close would be that number plus your down payment. If you put in a large earnest money deposit, you would reduce that earnest money deposit from that amount. There you go.
Can I do a bonus on that, Kevin?
Go ahead.
So an economic way, if people don't want to spend an extra $12,000 to $15,000 in closing costs, like Manley said, you got your closing costs from third parties, you got your prorations, and you got your points, which points is not to the lender. We don't get paid by your rate. We don't get paid by your program. We get paid by the volume that you close in as lenders. This is all lenders that are licensed. Hard money from your grandpa, not a different story. But when we say points, that is points of whatever the market is and where your rate is at that given time. So if you got 10 to 15,000 in closing costs and you don't want to pay that, you can easily add that and bake it into the purchase price. And people say, well, how does that make sense? Well, if you add 15 grand to the purchase price and ask for 15 grand from the seller, they net and they're like, that's fine. And you say 15,000. Now, yes, your payment may be higher, 30 to 50 bucks, but it would take you 10 years paying $50 to save 15 grand. So it makes economic sense to do that. If you guys are cash strapped and you want to get your closing costs covered, make sure you tell your lender or seller, bake it into the purchase price, and you just cut your costs in half.
That's all great as long as the seller approves of the seller credit and you don't have an appraisal issue in the works. So that's absolutely a bonus round and something we go down the path with every time. But thank you, Anthony.
All right, back at you, Anthony. Liabilities. How does it affect a loan?
Oh, yeah, this is great. A Lamborghini is a liability. You don't want to buy a Lamborghini while you're buying a house. You don't want to buy anything on credit when you have a house. You can use existing credit cards. That's fine. Liabilities are how we determine your debt to income ratio. All right. So we look at your income, then we look at your liabilities, and we come up with a debt to income ratio, or DTI. And so we want to make sure that once we approve you based off of your current liabilities, those liabilities don't go up. Now, I'm not saying the balances go up. I'm saying the monthly payments. You can have credit cards that go up. As long as the payments stay the same, your DTI stays the same. So just make sure when you're purchasing a house and you get approved in the beginning, you're not adding to your liability threshold, because then you're going to potentially kick yourself out of approval status.
So don't go buy that new car.
That after you close, or you're going to be marching back in there, giving them the keys and say, I'll see you in a week.
Yeah,
Or telling your boss to take this job and shove it.
Yeah, exactly. All those.
Oh,
things
God.
we talked about for you.
Kevin just made a great example. I can't tell you how many times, this is a bonus one. Do not quit your job or change jobs or do anything with your job until you are closed and recorded. Because the day that we push the fun button, we call Mr. Employer and go, is everything okay? Are they still employed? Is everything the same? And how many
Jimmy John
times?
still delivering?
How many times do Manley and I see our processors go, Houston, we got a problem? I was like, what's going on? Well, so-and-so decided to take an indefinite vacation. I'm like, and how many times do I call them and go, get your job back right now? And
Been there, done that.
And they do it.
It's ugly. People seem to do it. Don't know why, but yeah, all right. All right, moving off of that bonus.
All right, Manley. Points.
All right. So points, again, Anthony touched on a little bit, but we're going to take a percentage of the loan amount and pay a point, a half a point, whatever, to try to bring down the rate, like the interest rate. So the math is always going to tell us what to do. A lot of states, it's customary that you're paying a full point to get you in a lower rate right out of the gate. Wisconsin's not one of those. We don't pay a lot of points here necessarily. Not that we don't ever pay them, but the math is always going to tell you, do you need to pay a full point on a $500,000 loan? Are you going to pay a $5,000? And how much is that going to reduce your interest rate? And how long is it going to take you to recoup that full point or $5,000 through your monthly payment? So that's a good lender is going to walk you through the math and tell you the recoup tipping point, and you can go from there.
And does that point go in your pocket, Manley? Does that go to Manley?
Does not go in my pocket.
No, but it's your commission. I know it is. I know those points.
Not my commission. I don't get you just add the
you slimy lenders. You add in those points, and that goes in your pocket.
You already articulated that we're set on a maximum amount based on the loan amount. That's it. We can't change it. Nothing.
Our
else
fiduciary
happens.
obligation is to the client, not the rate and not the terms. So that way we do what's best for them.
Yes.
All right. Anthony, pre-approval versus pre-qualification or power bid.
This one is good. This one's really good. All right, listen up, peeps. It's a big difference. All right, you got pre-qual, pre-approve, and power bid. Now, us here at Rate, we do power bid. That is only us, no one else. If they have do other things, great. But a pre-qual is you're qualified, but it's an estimate. It's not, finely tuned to the granular. So can you get pre-qualified within 15 minutes? Absolutely. You do a 5-minute app, within 15 minutes, you're pre-qualified. Okay. But you want to make sure at minimum you're pre-approved. That means you send in your paperwork, you send in your pay stubs, you send in your taxes, you send in your statements. We look at the DTI, we scrub the credit, and we look at everything, and you're fully approved. Everything's been verified. If you want to go on a step further, which what I do personally, and I know Manley does as well with most of our clients, is we power bid. What does that mean? We don't just wait until they go into contract. We send them to the underwriter before. Yep, we can do that. A lot of companies can't because they don't have the upkeep and the manpower, but we can, and we send them to the underwriter and we get them fully underwritten, approved to where they have a blank check and all they need is an address. That helps not only the buyer have peace of mind, knowing that nothing's going to change, but most importantly, it gives the firepower, the rocket fuel for your agent to go into that offer and go, this client's not just pre-approved. They're fully underwritten approved. We can close this in 21 days. Let's get this and smash this down. That blows all the competition out of the water. And that is why you need a trusted lender to make sure that they're not just getting you approved, but they're getting your offer accepted.
The power bid is king, and it gives you a full loan approval. All you need is an accepted offer, a fully accepted offer. Then we need an appraisal to support the offer price. We need clear title, homeowners insurance. And actually, we can close in a lot quicker than that. We're going to do a rush on that appraisal. We're going to get that whole thing turned around in 12 days. Boom. See, you're in the house. You can write a cash offer with that. You just need your appraisal. And it doesn't get any nicer than that, folks. It just does not get any nicer. And if you don't do a power bid with us as a lender, you're making a mistake. You are not bulletproof out there, and you are in a war zone.
You just gave me PTSD, Manley. My now 13-year-old, we played Yahtzee a couple weeks ago, and man, she just kept throwing them Yahtzees. And I'm like, man, those trick dice, what is going on with you? I was like, no, forget this. We're playing Battleship. And then she freaking sang my battleships, and I'm like, all right, we're freaking playing Uno. And then she's got this new Uno where it's like must draw 10, must draw 20 cards, and the stack is like this big after about 45 minutes. And I'm like holding like a million cards. I'm like, go do your homework, kid. Like,
I love that. I love that. That's amazing. Awesome. All right, Kevin, what do we got next?
All right, Manley, loan estimates.
Loan estimate. Well, that's right along the same lines of what we talked about before, the cash to close. This is a little more detail, and there's some bells and whistles that you need to know about the loan estimate, or the otherwise known as the LE, the loan estimate, that we have to provide all this documentation, and it is an estimate, but we can't exceed certain items on that estimate by more than 10%, or we have to pay the difference. So are we going to overestimate things on purpose? Absolutely. But there are certain things that can't change at all. Like our lender fees can't change at all. The appraisal fee, that can't change. It can have a 10% change on a $600 appraisal. That means it can change by $60. After that, we're paying for it. So there's all these components that tells you dollar for dollar where you're going to see it and what you think it's going to be come closing time. But it is not the final to the penny. It is the estimate, and we are overestimating it on purpose. So it gives you that warm and fuzzy. Here we are. Good loan officer will walk you through it line by line and explain to you where there's fluff in the estimate and where there's not. And when you compare apples to apples from one lender to another, you really want to listen up, because people do bake stuff in all the time that doesn't become fluff. It does become actual. That's just, we only know that by being in the industry for close to 24 years.
All right, Anthony, underwriting.
Basically, that is the judge in our world. Okay, we're the attorney, the client is the client, and the underwriter is the judge. Now, not to say you don't, ask for a sidebar every now and then. Not to say that we're going to say objection, with things that they come back to us, but you don't want to bite the hand that feeds you. And as long as you're working with a reputable company with good underwriters who understand guidelines, it's black and white for the most part. There is some gray area with interpretation, very little of that. And that's when we come in and say, objection. But yeah, underwriting is when they take all of the information and they look at AUS, which is the automated underwriting system, okay, or it's LP for loan prospector for Freddie Mac, or it's DU for desktop underwriter for Fannie Mae, and it's an automated system. So the central bank, there's millions of loans a year. They can't have people in the back office typing like cats going approved, approved, approved. So what they do is they do this automated system, this algorithm that looks at the credit, the assets, the income, the DTI, the LTV, the credit risk, all that other stuff, and they spit out approve eligible, refer eligible, or ineligible. And then they take that, and the underwriter's job is to look at that piece of paper and go, they say it's a 700 FICO, credit 700. They say they make 15 grand a year. They say they make 15 grand a year. They say they have child support. They have child support. So their job is to checklist the AUS findings, and it's done.
Yeah, is it that simple? I love that. There are some nuances to that make it just a little harder than that. And the one thing to point out is all that documentation that we get is all third-party verified, and then it is verified again by the underwriter to make sure that it's third-party verified and understood.
That is so important that you said that, because people don't understand that when they send stuff to us, we double verify through third parties. So if you send us pay stubs, we contact the employer. If you send us taxes, we contact IRS. If you send us credit, we contact Informative and other types of credit portfolios. We verify through third parties everything that they give us. I can't, there's not a lot of times, thank God, but there are some times where people will give us stuff and they'll be like, here's my taxes. I show $500,000 a year on my Schedule C. See right there, line 30? I'm like, oh, that's amazing. You make so much money. And then we get the tax transcripts from the IRS. And I'm like, well, looky here. They wrote off 480,000 and their net is 20. I'm like, interesting. They didn't give me the final draft. And then I got to call them and go, well, I pulled the tax transcript and you wrote off 480,000 of the 500. So the version you gave me is incorrect. Oh, I'm sorry about that. So yeah, that happens a lot too.
Deep in the weeds, but what if I depreciated $400,000 worth of assets? Can I add that back, Anthony?
Oh, yes, I can. That's line item 13 on the Schedule C, and that's line item 22 on an S Corp, and that's line item 23 on a C Corp. You can add back depreciation. So if you have a super savvy CPA who understands how to scrub deductions in a way that it offsets your earned income, but doesn't offset the bottom line, that is chopping it smart.
That is. And back to the point of that was third-party verification of all of our assets, income, the credit reporting, all that's done. The one thing that you didn't mention here on underwriting is our smart underwrite, which we've talked about in other episodes. And smart underwrite is taking that information that's third-party verifying through our gateless program and going third-party verifying assets, verifying income. And then we get a credit report to match, and boom, double Yahtzee, not to make you shake and cry again, but double Yahtzee, we get an approved loan in less than 2 hours. I mean, an approved loan. No underwriter goes and double checks it anymore because power.
You want me to say it, Manley? You want me to say it? I'll say it. Just tell me. I'll say it. Just tell me to say it.
You say it.
The underwriter days are numbered. I said it. I said it.
Don't be so mean. They're watching us right now. We're going to get in trouble. The next favor I need for them to look at it a little differently, I'm not going to get it, Anthony. Be careful. Be careful.
For the underwriters that are watching this, that work with us, turn away. But yeah, we love you.
We love you. We love you.
But they're numbered. I mean, it is mind blowing of what we're going to see over the next 5 to 10 years in technology with AI. And we are going to see the biggest transformation since the Industrial Revolution over the next 10 years. Mark my words. And everything, like what used to be easy is now, not even a thought. What used to be hard will then be easy. What used to be impossible will be hard. And if you're not on that train of AI, like underwriters, like processors, like a lot of stuff like that. I mean, shoot, even doctors now. I just saw a TikTok where a doctor was like shaking in his boots. He's like, I'm putting in my resignation now. He's like, I spent 8 years looking at x-rays to understand what I'm looking at. And now the hospital has this application where I have to check to see if it's correct. And so far, it's better than me. And so I think I'm training my replacement and letting him know. So he's like, I think
Hanging
they're
up
just
my hat.
to throw me away. The same thing is with our world. It's going to change. Underwriters, processors, assistants, operations. It's all going to be automated. And yeah, so that's underwriting is on that boat.
Quit scaring me with your AI woes. All right, Kevin, on to the next.
All right, Manley, escrow account.
Escrow accounts. Escrow holdbacks or escrow accounts are basically two of the items that we typically hold back. And this is all related to what are the three major risks of the credit itself or the borrower buying this house. Remember, we are putting together a marketable security and the collateral is the asset itself. So we have three levels of risk that we need to mitigate. The first one being the borrower, we're going through all the process to triple check, double verify his income, his assets, all that. We're giving him a green light to go. The second one is the appraisal itself, and that's going to tell us whether the collateral holds water. The third one is going to be, does the house burn down and nobody's going to pay it back? Well, we got to get homeowners insurance, and we're going to control that homeowners insurance. And then does the municipality take the property back because somebody failed to pay the property taxes? So we're going to escrow the homeowners insurance and the property taxes typically. So we're going to take the annual bill of $1,000 for homeowners insurance, and we're going to divide that by 12. So you're going to pay an $83 a month contribution to your homeowners insurance escrow account, and then you got a $6,000 property tax bill. So you're going to pay, whatever that comes out to be, $4,500 a month for that to get you your property tax paid for. It's going to be set in an account, and it's going to be building up, and either the lender or the servicer is going to make the payments for you. And again, protecting their asset and mitigating all the risks. Sorry, that was long-winded.
All right, Anthony, amortization.
Amortization, it's the amount of interest paid over the lifetime of the loan. So, people get shocked when they look at the amortization schedule and they go, I'm paying $700,000 in interest over 30 years. And that's it. I mean, banks are banks for a reason, just like casinos are casinos for a reason. And if someone doesn't have $500,000 to put down in cash, they're going to pay that $500,000 over the lifetime of the loan. They're going to double that. And so that's why it's smart to trip the amortization schedule and pay extra. A lot of people pay 3 payments a year divided by 12 and pay that extra to where you can chop off that, amortization by half and make a 30-year into a 15-year. And now you're cutting the interest in half. So I don't want people to be too concerned on that, because then they'll be in a catatonic state of, I don't want to pay $700,000. Well, you got to look at it as if you're paying $700,000, what are you gaining? Not only as a dwelling, but all the rest of the levers of economics. In a perfect world, if you could pay $500,000, great. But then you also have to think, if you put $500,000 in the stock market in 30 years, it's going to be a lot more than $500,000. Okay. If you put $500,000 in a money market or a yield account, you're going to make a lot more. So it takes money to make money, but I'm still a big proponent on debt equals income and income equals debt. And there's no exception on an amortization. Yes, you pay interest a lot over the next 30 years, but it allows you to be in a debt position to not have to put all your money in one basket, and you can leverage it. And I guarantee you, all you math professors, if you look at me amortizing over 30 years, and that's my interest I'm paying, but then I take that money that I saved and I invest it in others, you're going to be much better on the investments than what you paid on the debt.
Like it. Good answer.
All right. And the final buzzword of today, Emily, rate lock.
So the old infamous rate lock. There's a lot of nuances to this. I'm going to simplify it just for this because I don't want to go through every single one of them. But a rate lock is when you have talked to your lender and you've decided that you're going to lock at whatever market rates are. And we're going to do a 15-day lock or a 30-day lock or a 45-day lock, whatever's necessary. And hopefully that lender's telling you the difference in that cost for those different timelines that I just mentioned, because the shorter the time frame, the better the interest rate. So not saying that you sit there and play the market, but you need to have an understanding of what's going on. But once you lock it, the one good thing about our company rate is we have a float down feature that a lot of people don't have. If the interest rate moves 0.3% from the time that you locked, and you got up until about 6-7 days before you close to pull that trigger, you can reduce the interest rate really at no cost to you if it moves 0.3%. Anything less than that, there isn't the room to do that. Why? Because we have pull-through issues that happen. If we lock rates, we have to deliver. We are on a best efforts delivery system, and we get dinged, and it makes our cost overhead more expensive if we don't deliver the lock. So we have to make sure that we're protecting ourselves and not moving the interest rate for an eighth. So it's a business decision, and that's how it works. So again, rate lock is great. Understand the timing of it, what it means to you as the consumer, and then also just do they have a rate float down feature? That's important. Not many people have that. Want to add to that at all, Mr. Anthony?
You did. I mean, I would say it's like Russian roulette. You don't want to roll the dice and then all of a sudden the rates jump up 0.5%. And now what are you telling the buyer? So I always have a conversation with them and I say, listen, based off of the current tumultuous, volatile market, I think we should lock. Unless we're 60 days out, then we can roll the dice. And then another way that I float is the other word is floating, where you don't lock it, you just float it throughout the transaction until you rate lock. Is if the market is pricing in a defensive position. So sometimes in our world, the market will price in a defense position, saying they don't want any locks right now, and they're making it painful. And that's very temporary, only like 3 days to a week at most. And when we notice like, oh my God, these are god awful, that's basically the market going, y'all need to float until we figure this out, because we don't want this position. We're going on the defense. So they make it really painful unless you have to lock. So we typically float in those times.
That's how they mitigate their volatility that they're creating. And we're in that perfect storm right now. There's enough volatility out there from outside forces that are creating interest rate to peak because they don't want the locks. So that's just what's going on for there.
And Anthony, with your current game losing streak, stay away from Russian roulette.
Yeah. Oh yeah. No. Oh,
It comes in threes, Anthony. It comes in threes.
I will tell you though, we play poker every weekend and and I'm usually the only male. There's like 7 females, my wife and all her friends, and I just sit there and mind my P's and Q's and do my thing. And we do like a $20 buy-in, and then they bet like 5 cents. And then like when I do like 25 cents, and I'm like, they all look at me and they're like, this freaking guy. No, how are you going to bet 25 cents? And I'm just like, man, I need to play. But yeah, I agree.
He's whipping out the crumbs.
Yeah. Shout out to my poker girls. I love you guys.
I love them.
I'm not saying anything negative. I'm looking forward to it.
Nope. Sounds like a fun crowd. Just be careful. They'll slit your throat if you're not.
Yes, they will.
Cards. All right, Anthony. All right. Big picture takeaway is that yes, rates are high, listings are up, but prices are still rising. So now you know why. And you just got to make sure you're educating yourself and making sure that you understand what you're getting into. And if you're waiting, why you're waiting and why you're doing that to yourself, to not get yourself dip that toe in the water, make it happen, get a professional, get somebody to help you make a good decision. That's what I'm going to say. How about you, Anthony?
Yeah, I mean, for all of our listeners who are buyers or potential buyers or already owners and looking to invest, as simple as this. You need to plan ahead and plan smart. You need to get sound advice from professionals who are in the trenches every day. And if you're waiting for the perfect storm to happen, you're going to wake up one day and realize that storm has passed. You have to be 2 steps ahead of the curve. What I mean curve is if it's curving up or curving down. You always want to be 2 steps ahead because you don't want to be a part of the herd. If you're part of the herd, you're not going to see exponential results. Like I tell my daughters on a daily basis, you have to chase the no's. Don't chase the yeses. The yeses is fail-proof, but there's very little growth in it. And the no's are you have to search for knowledge. You have to search for education. And yes, it's unknown, but at the end of the day, you're setting yourself up for long-term success. So, plan ahead, get good advice. Don't wait for the storm. If you want to buy now, but buy with confidence and education behind it.
Awesome news. Awesome stuff right there, Anthony. Appreciate it. Hey, you guys, just wanted to say thank you very much for being here. Kevin, thank you very much for all your help in the background and helping us out with the our big rapid fire round and the great questions that you came up with. Appreciate that. Hopefully our listeners and viewers are getting some good knowledge out of that. Anthony, big weekend ahead of you. I know happening over there, something really special in town. One of your daughters is having a wedding, correct?
Yep,
You're
my
adding a family
oldest
member.
my oldest princess is getting married, so I'm handing her off. This will be 1 down, 3 to go. So it'll be fun, man. It'll be a good time.
There's a big days. Looking forward to hearing all the great stories and seeing the great pictures. It's just those are magical moments. Good for you, buddy. Good for you.
Absolutely.
Well, again, thank you, everybody. Thank you to our listeners and our viewers for stopping in at the Mortgage 101 podcast with Anthony and Manley. If you like what you hear, smash that like button, subscribe, share, send a message. If you want to have some topic talked about on our show, reach out to us, write a good review, write a bad review, and tell us what we're doing wrong if you need to. But hey, we need input. We love you guys. Appreciate it. Have a good one. That's a wrap for today's episode of the Mortgage 101 podcast with Anthony and Manley. Remember, the market is always shifting, but smart buyers stay ready. If you learned something today, smash the like button, hit subscribe, share this with someone who needs to hear it, and or drop us a mortgage question for future episodes. Thank you so much for watching or listening. Hope to see you soon. If this episode helped you feel more confident about your home buying journey, do us a favor. Share it with a friend, subscribe, leave a review, and if you've got a question or a topic you want us to cover, hit us up with a DM or a comment. Thanks for listening to the Mortgage 101 podcast. We'll see you next time.